Volatility is an inherent part of the investment experience. After all, we can't control the performance of a particular asset class or market, but you can help manage some of that volatility by diversifying your portfolio. Today, we're going to look at what diversification is, why it matters, and how you can implement it. So what is diversification? Diversification is a portfolio management technique that reduces volatility by investing across different asset classes, sectors, and markets. By doing this, you reduce the impact when one part of your portfolio is performing poorly. The idea is that when one asset class zigs, another asset class zags. Different asset classes or types of investments exhibit different levels of volatility. For example, stocks have high growth potential but are usually quite volatile, whereas bonds offer lower returns but are generally more stable. You also gain diversification benefits by investing outside of the US and Canada. From 2001 to 2021, the US was only the top performing country in 1 year, 2014. Over that same time frame, it only showed up in the top 3 countries on 5 separate occasions. And in terms of annualized performance over that 20-year period, it ranked 5th, beaten by Hong Kong, Australia, Denmark, and New Zealand. In any given year, the difference between the best performing country or asset class and the worst performing one can be significant. In 2017, for example, Austria was the best performing market in the world, gaining 59% in US dollar terms. The very next year, in 2018, it was the worst performing market in the world, losing 27% of its value. Likewise, individual stocks exhibit wide ranges of returns, and only about 20% of US stocks survived and outperformed the market over 20-year periods in the past. You can't reliably predict which stock or asset class is going to outperform in the future either. Over that same 20-year time frame, only about 1/3 of stocks in the US that outperformed over the previous 20 years actually outperformed again over the next 10 years. Rather than trying to outguess the market by picking individual stocks, diversify your portfolio across many stocks and many asset classes, or better yet, own the total global stock market. That way you reduce the impact that a few bad performing stocks have on your whole portfolio. Mutual funds and exchange traded funds, or ETFs, offer very simple, cost-effective access to diversified portfolios. These types of funds can invest in nearly anything, including stocks, bonds, commodities, real estate, and more. And while these funds do have embedded fees known as management expense ratios or MERs, they're usually more cost effective than you trying to put together your own well-diversified portfolio all by yourself. So while diversification doesn't completely eliminate volatility, it does help protect you during market downturns. Owning a diversified portfolio that's in line with your goals, risk tolerance, time horizon, and investment knowledge can help you stay invested and provide you with a more reliable and consistent investment experience. If you found this video helpful, please share it with your friends, family, and colleagues. And if you'd like to chat about any of this further, feel free to get in touch.